Good morning. This is Dave Toth with an RJO MRT Technical Webcast update on the S&P E-mini, the mini NASDAQ, and 10-year T-note markets for Tuesday, June 5th. Starting off here with an intraday 4-hourly chart of the June S&P contract, you can see the past couple of days or this week's recovery attempt that exposes the very minor term trend as up, but within the context of the broader slide over the past couple of months from March 27th's 1420 high to this point, this recovery attempt cannot be viewed as anything other than bear market corrective, with strength above at least former support turn resistance between 1287 and 1294, and preferably the 1305 minor first wave low from last Thursday required to jeopardize the impulsive integrity of the broader slide enough to warrant shorter term traders with tighter risk profiles to take defensive steps. In lieu of such strength above 1305, again, traders are advised to first approach this recovery attempt as a corrective bear flag, selling opportunity ahead of a resumption of the broader slide. Moving to a daily log scale perspective, you can see the magnitude of the past 2 months break. And in fact, this trend remains arguably down, with strength above the 1334 corrective high from May 30th required to confirm a bullish divergence in momentum of a scale sufficient to break this longer-term downtrend. Now, indeed, you can see the developing potential that this slide from that March 27th high at 1420 could be a completing 5-wave Elliott Wave sequence that would expose a large degree correction or reversal higher. But again, strength above that 1334 corrective high is what's needed to break this clear and present yet simple downtrend pattern of lower lows and lower highs and confirm this threatening bullish divergence in momentum. Moving to a weekly log scale perspective, you can see the break below most levels of technical merit over the past couple of months, including the break below last October's 1289 area of former resistance, new support. The market is in the general area of the 38.2% retrace of the entire October-March rally in the 1273 area. But again, the trend is down on an intermediate to longer term scale with strength above 1334 required to threaten that view enough to warrant even longer term traders move to a neutral sideline position. In sum, a bearish policy remains advised for both shorter term traders with tighter risk profiles and longer term traders, with strength above at least 1305 required to warrant shorter term traders with tighter risk profiles take defensive measures. And from a longer term perspective, strength above 1334 is required to move to a neutral sideline position for all traders. In lieu of such strength, a resumption of this broader slide to new lows and potentially significant losses below yesterday's 1262 low should not surprise. Moving to a daily log scale chart of the E-mini NASDAQ 100 market, you can see also the developing potential that the last week or the late May's portion of the decline could be the completing 5th wave of a 5-wave Elliott Wave decline from that April 3rd high at 2791. You can also see the developing potential for a bullish divergence in momentum, but proof of strength above the 2570 corrective high from May 29th is required to confirm this divergence, break this broader downtrend, and expose a larger degree reversal higher. In lieu of such strength above 2570, this downtrend remains in fact intact, and further and possibly accelerated losses should not surprise. Now, from a very long-term perspective, looking at the weekly log scale chart, it is very interesting to note the combination of support candidates from the 50% retrace of the 2136 to 2791 rally, the portion of the rally from November's 2136 low that cuts across at 2442, and in the same general area of as major but yet former resistance from the first half of last year, ranging between 2403 and 2435, that now serves as a support candidate from which the longer term uptrend could resume. But again, to verify any rejected low as a reliable low support and risk parameter, this market needs to stem this clear and present downtrend with proof of strength above 2570. From a shorter term perspective, looking at the 4-hourly chart here, you can see the developing impulsiveness of the past week's sell-off, including the past couple of days recovery attempt that thus far has only retraced a Fibonacci minimum 38.2% retrace of this latest portion of the break from 2570 down to 2433. And per that developing impulsive downtrend, We have defined the 25-20 low from May 30th as a minor first wave low, and the short-term risk parameter this market now needs to recover above to jeopardize the impulsive integrity of not only a shorter-term wave sequence down, but the longer-term one as well. And shorter-term traders with tighter risk profiles are advised to take defensive steps if the market can prove strength above 25-20, and such strength would also probably spill over into the S&P market as well. In sum, a bearish policy remains advised in E-mini NASDAQ with strength above at least 25-20, and preferably the 25-70 high from May 29th required to warrant even longer-term traders move to a neutral sideline position. Finally, looking at a longer-term daily log scale close-only chart of the 10-year yield, on the yield on the 10-year Treasury notes. You can see the market's recovery thus far from a 1.45% low back on June 1st. That's just within a couple of basis points of the 0.618 progression relationship of the net distance of waves 1 through 3 from that March 19th high yield at 238 down to the 1.70 yield from May 17th. If you take that entire distance, multiply a 0.618 progression relationship from that 177 high on May 24th, it projects to 143. You can also see the developing prospect for a complete 5-wave Elliott Wave sequence amidst a developing potential for a bullish divergence in momentum. But on a scale sufficient to break this longer-term trend down in rates, we would need to see strength above at least former support turn resistance in the 1.70 yield area, and preferably strength above the 177 corrective high from May 24th in order to expose a larger degree reversal higher in rates. And from a 10-year T-note futures perspective, similarly, you can see the developing potential for a 5-wave wave sequence up from that March 20th low at 126.27 amidst the developing potential for a bearish divergence in momentum. But on a scale sufficient to break this long-term uptrend, we need to see proof of weakness below the 132.08 corrective low close from May 22nd to confirm this as a complete Elliott Wave sequence and expose what could be a major reversal lower in 10-year T-note prices. In lieu of such proof of a larger degree proof of weakness, it's easy to see the prospect that the past couple of days setback is merely another corrective setback within the secular bull trend in T-note prices. From a short-term perspective, looking at an intraday 4-hourly chart, you can see the past couple of days setback that arguably breaks the previous week's uptrend and defines the 134.30.5 high from June 1st, this past Friday, as one of developing importance and arguably a shorter-term risk parameter from which shorter-term non-bullish decisions like long covers and cautious bearish punts might be objectively based. But again, within the context of the secular bull trend in T-note prices, we strongly suspect that this setback is merely another corrective setback within the broader uptrend, and we will be watchful for a bullish divergence in short-term momentum needed to offset this recent bearish divergence in short-term momentum that we believe will re-expose the longer-term uptrend to another round of new all-time highs above 134.31. While that high remains intact, however, certainly shorter-term traders with tighter risk profiles have some semblance of an objective level and a short-term risk parameter around which to base non-bullish decisions, and also a level above which to reset a bullish play or a bullish position in a continuation of the secular bull trend. And again, with a longer-term risk parameter at 132.08 on a daily close-only basis and 132.11 on an intraday basis that we believe this market needs to break below to expose a much larger degree correction or reversal lower. Please stay tuned to updates on these and other markets on our rjomrt.com website, and good luck with today's trading.